both of our shares had the same holding period. All else equal, for tax purposes, I'd rather take a short-term loss than a long-term loss. You want to avoid all taxes if you can, but you really want to avoid paying that short-term capital gains tax because it's so much higher than the long-term rate. Some people go so far as to trade options to lock in the gain without realizing taxable income. The goal is to transform the short-term gain into a long-term gain. The mechanics of such transactions are a little tricky, and you probably won't use this strategy too much, at least not at first, so we won't go into it. You have to trade two options to do this, and you're also ruling out the chance to benefit from further price appreciation. That might be more trouble than it's worth. There's another potential benefit to locking in the profit until the long-term rate kicks in, though. Remember my economist friend in Lecture 10 who needed to rebalance his portfolio because he had accumulated too much in stocks? If you hit the jackpot on a stock and it doubled or tripled, then you might feel that you're no longer diversified. If that's the case, then the option strategy makes more sense because you've locked in a sales price. The stock is no longer a risky asset, so you don't need to diversify against it. If you find yourself in this position, then talk to your broker or tax advisor. If you're thinking of making a charitable donation, then I have some great news for you. Instead of selling stocks that have increased in value, paying the capital gains tax, and then donating what's left, you can get a big tax break and help your favorite charity more if you just donate the shares themselves. You won't pay capital gains taxes because you didn't sell, and a tax-exempt institution such as a church or your alma mater won't pay any taxes anyway. Your tax credit for donating is bigger, and the recipient gets a bigger donation. What's not to like? On a somewhat more somber note, you'll also get a tax advantage if your stocks are in your estate. To be precise, your heirs will get the tax advantage. They may have to pay an estate tax, but they'd have to do that anyway. If you include the shares in your estate, then your heirs won't pay capital gains taxes, and they'll be able to update the tax basis of the stock to the value of the shares when they receive them. We've been discussing how to minimize taxes on your capital gains. You're going to pay taxes on your dividends too. Usually you'll pay taxes on your cash dividends at a lower rate than ordinary income. Congress changes these rates a lot, though, and there are special rules and exclusions that come and go depending on the way the wind is blowing in Washington at the time. Avoiding taxes on dividends is harder than avoiding capital gains taxes. That's because you can't control the timing of the dividend like you can the capital gain. You get the dividend when the corporation decides to pay it, not when you decide to sell the stock. The investment implication is that you should buy low dividend stocks, all else equal. If you buy high dividend stocks, then you'll probably end up paying higher taxes. Low dividend companies tend to be either growth companies, which need to reinvest their cash, or companies that have fallen on hard times. They don't have earnings to distribute in the first place. Remember, as I mentioned in Lecture 2, stock dividends aren't the same as cash dividends. If a company sends you cash, then that's a cash dividend. That's taxable. A stock dividend just chops the claims on the firm into smaller pieces. You might get 1.1 shares for every share you currently hold. Stock dividends are generally not taxable. Stock splits and stock dividends change the basis of your shares, though. If you have 10 shares and their basis was $11 per share before a 1.1 for 1 stock dividend, then it's $10 after. Your basis for all of your shares is the same, though. The IRS knows that changing 10 shares worth $11 each into 11 shares worth $10 each doesn't change the total value of your investment. Mutual funds aren't immune to the tax man. You'll get a statement every year reporting your dividends and capital gains from the fund. Knowing what you learned today about realized gains being the tax trigger, which do you think will give you a bigger tax bill? an actively managed mutual fund that trades a lot, or an index fund that hardly trades at all? You're right. An actively managed fund will generate more realized gains than a passive fund, which means a bigger tax bill. Some mutual funds make an effort to minimize your tax bill. At last count, the Vanguard Group had at least 5 mutual funds that are designed to maximize your after-tax returns. These funds follow the rules we've listed here, but they do it at the mutual fund level. They sell losers and let the winners ride. They trade as little as possible. And if it's consistent with the fund's other objectives, they hold low dividend stocks. I think this is a great way to run a mutual fund. In our next lecture, we'll look at some powerful investment vehicles that will help you limit your tax bill even more: individual retirement accounts and 401k plans.